All right, listen up. We're talking about making money, and one of my favorite ways to do that is with something that has been valuable for thousands of years. I'm talking about silver. It's not just for jewelry or fancy silverware, folks. Silver is a crucial industrial metal. It's in your phone, your solar panels, and your electric car. This isn't just a pretty face, it has real, tangible demand that keeps growing. When industry is booming, the need for silver goes through the roof. That's a powerful tailwind you want on your side when you're investing your hard-earned cash. Now, you could go out and buy a bunch of silver bars. You could store them under your bed, but that's a headache. It's heavy, you have to worry about security, and it's tough to sell quickly. Forget that. There's a much smarter way to play this. It's called SLV, the iShares Silver Trust. This is an exchange-traded fund, an ETF. Think of it as a big, secure vault full of silver, and you can buy a tiny piece of that vault just like buying a stock. It trades all day long on the stock market. When the price of silver goes up, the price of SLV goes up. It's simple, it's liquid, and it's your easy ticket into the silver market. So why now? Why silver? Look around you. We're seeing a massive push towards green energy and electrification. Solar panels need tons of silver. Electric vehicles are packed with it. On top of that, silver has always been a safe haven asset. When the market gets choppy or inflation starts to rear its ugly head, investors run to precious metals like silver and gold. It's a hedge, a form of financial insurance. This dual demand, from both industry and investors, makes silver a fascinating place to put your money to work. It's a dynamic asset that can perform in different economic climates. The trends are our friends, people. Pay attention. The global demand for silver is on a tear. We're not just talking about a little blip. We're talking about a long-term structural shift. As developing nations get richer, they want more electronics. As the world fights climate change, it needs more solar panels. All roads lead back to silver. By owning SLV, you're not just betting on a shiny rock, you're betting on industrial progress, technological advancement, and a proven store of value. It's a powerful combination, and it's the foundation of the strategy I'm about to show you. Booyah! Now let's get to the fun part, the strategy. You don't have to just buy SLV and wait for the price to go up. No. We're going to be proactive. We're going to get paid to be ready to buy it. This is done with something called a cash-secured put. Don't let the name scare you. It's actually very simple. Selling a cash-secured put is like making a binding offer to buy a stock at a lower price than it is today. And the best part? You get paid cash right now just for making that offer. That payment is called the premium. It's instant income that goes straight into your brokerage account. Let me break it down. Imagine SLV is trading at $25 a share. You can sell a put option with a strike price of, say, $23. This means you are telling the market, I am willing and able to buy 100 shares of SLV for $23 each, anytime before this option expires. For making this promise, another investor pays you money, the premium. If SLV stays above $23 until the option expires, you just keep the premium. The option expires worthless, and you made money for doing almost nothing. You can then turn around and do it all over again next month. It's like being the insurance company for the stock market. But what if the price of SLV drops below your $23 strike price? Well, then you have to follow through on your promise. You get to buy 100 shares of SLV at $23 per share. This is why it's called cash secured. You must have enough cash set aside in your account to buy those shares. In this case, you'd need $2,300 as collateral. But here's the beautiful part. You wanted to own SLV anyway, right? And now you're buying it at a discount to where it was, plus you got to keep the premium you were paid up front. You're buying a great asset at a price you already liked. This isn't some wild speculative gamble. It's a calculated conservative strategy. You are defining your entry point. You are choosing the price at which you are a happy buyer. You get paid while you wait. If the stock goes up, you win by keeping the premium. If the stock goes down, you win by buying an asset you already wanted at a cheaper price. It's a win-win scenario. This is how you turn a volatile market into your personal ATM. You are using patience and planning to generate a consistent stream of income month after month. It's a beautiful thing. Okay, let's put this into action with your $10,000. This is your seed money, your capital to start this income-generating machine. The first rule is that we never risk the whole 10 grand on one trade. We are methodical. Let's say SLV is trading at $25 per share. We need to find a put option to sell. We are looking for an option that expires in about 30 to 45 days. This is the sweet spot. It gives the trade enough time to work, but doesn't tie up our capital for too long. We want to be collecting these premiums every single month like clockwork. Now, how do we pick the right option? We use a little something called delta. Think of delta as a probability gauge. An option with a delta of 0.30 means there's roughly a 30% chance that the option will be in the money at expiration. That also means there's a 70% chance it won't be. We want to sell puts with a delta between 0.2 and 0.3. This is our safety zone. We are deliberately choosing a strike price that is far enough below the current stock price that we have a high probability of just keeping the premium and walking away. This isn't about hitting home runs. It's about hitting singles over and over again. Let's do the math. Your $10,000 is your collateral. If we sell a put with a $23 strike price, we need to set aside $2,300 for that contract. With $10,000, you could sell 4 of these contracts. Let's say the premium for that $23 put is 50 cents per share. Since one contract is 100 shares, that's $50 per contract. By selling 4 contracts, you instantly collect $200. That's a 2% return on your $9,200 of collateral in just 1 month. That's your passive income. The monthly cycle is simple. You sell the puts, you collect the premium, then you wait. If at expiration, SLV is still above your $23 strike price, the options expire worthless. You keep the full $200, and your $9,200 in collateral is freed up. What do you do next month? You do it again. You find another 0.2 to 0.3 delta put option and sell it, collecting another round of premium. This is how you create a consistent, repeatable income stream. You are the toll booth operator on the Silver Highway, and every month, people pay you a toll. This is where it gets really exciting. I'm talking about the magic of compounding. That $200 you made in the first month, don't go spend it, you reinvest it. Your capital base is now $10,200. The next month, when you make another 2% return, it's a 2% return on a bigger number. It might not seem like much at first, but over time, this is like a snowball rolling downhill. It gets bigger and bigger, faster and faster. Let's run the numbers over 5 years. That's 60 months of collecting premiums. If you start with $10,000 and earn an average of 2% per month, after the first year, your account would grow to over $12,600. Keep it going. After 3 years, that initial $10,000 could be worth more than $22,000. And after 5 years of consistently executing this strategy and reinvesting every penny, your $10,000 could balloon to over $32,000. That's the power of compounding at work. You are making money on your money. It's a wealth-building machine that you can set up and manage with just a little bit of work each month. This is how you build real, lasting financial freedom. Now, I'm not going to tell you this is risk-free. Nothing in investing is. The main risk is that silver's price takes a nosedive. If SLV falls hard and fast, way below your strike price, you will be forced to buy the shares. You will own SLV at a price that is higher than the current market price, meaning you'll have an unrealized loss on paper. You might have to hold those shares for a while and wait for the price to recover. This is why it's crucial that you only use this strategy on an asset like SLV that you are genuinely happy to own for the long term. But let's weigh the risks and rewards. The reward is a consistent monthly income stream with the potential for incredible long-term growth through compounding. You get paid to wait to buy an asset you already like at a discount. The risk is that you might have to buy that asset during a market downturn. But even then, you own a valuable, tangible asset with strong industrial and investment demand. For me, that's a risk worth taking every single day of the week. This strategy puts you in the driver's seat. It's smart, it's calculated, and it's your path to generating serious passive income. Now go out there and make some money.